Very good evening to all our viewers. You're tuned into WION World is One News and I'm Chaiti Narula and welcome to the Union Budget Special. Now, for the past couple of years, public sector banks in India have been facing a lot of ire from experts and civil society for their rising non-performing assets or NPAs, the assets or the loans that the banks won't be able to recover. Does this unhealthy position of banks reduce the availability of funds for people? Is it a reason for the banks to be sticky in reducing the interest rates? This and more we will cover on today's budget special on banking, insurance and the financial sector. We're joined by two experts, Dr. Krishnamurthy Subramaniam, Member, Board of Director at Bandhan Bank and Associate Professor at ISB, and Mr. S.C. Sinha joins me in the studio right here at the WION headquarters. He's the former Executive Director of Oriental Bank of Commerce. Now, in 2015, India's Central Bank, Reserve Bank of India or the RBI tightened its noose around the country's commercial banks and asked them to come clean with their bad loans. As of June 2016, which is mid last year, the total gross bad debts in India's public and private banks stood at a whopping 6 trillion rupees. Let's take a further look at the story.
In the Union Budget Financial Year 17, 250 billion rupees were budgeted to infuse fresh cash in the banks to improve their tarnished accounting books. The banks have been facing severe criticism for their rising bad debt. The Indian government has also left the population disappointed in terms of the actions taken. It announced that it will take criminal action against bank loan defaulters, but no concrete plan was announced in the end. Instead, to enable the banks to recover their bad debt, the government has permitted foreign investment in asset reconstruction companies. However, the experts criticized that as a means to sell bank loans at a discount to foreign companies in order to clean their balance sheets. As per industry estimates and aggregate reports, the public sector banks would need an additional capital of up to 2.4 trillion rupees by 2018 to meet the Basel III capital adequacy norms. These norms are put in place by the Bank of International Settlements to avoid a repeat of the 2008 financial crisis. In the customary pre-budget meetings, bankers sought tax exemptions for their bad debt on bank savings of senior citizens, especially after demonetization, more capital infusion and a waiver of service tax for banks. With a whole host of reforms including demonetization done in 2016, the next budget is unlikely to be a conventional one. Steps will be required to restructure the economy and the banking sector. A report by Chaiti Narula for WION, New Delhi.
Let's go over now to our panelists who are standing by with us to discuss the banking and the financial and the insurance sector in much detail. I'm going to start off with Mr. S.C. Sinha, who's the former Executive Director of Oriental Bank of Commerce. Good evening, sir, and thank you so much for joining us here at the headquarters on the Union Budget Special. Indeed, a pleasure to have you here on the show today. You know, we just took a look at that story that just played out. How do you think our banks have ended up having such a huge debt? What really led to this accumulation of bad loans for the banks?
You see, bad loan comprises of many various factors. And for the last 2 years, I am finding the economy is on a downturn. Credit pickup is not there, and there is no avenue for further investment by the banks. So this has created a new challenge before the bank. One way, credit is not getting picked up. Another way, loans are getting stressed. Bank has come out with of course, with the permission of Reserve Bank of India, several measures, but still it has not checked the continued increase of stress assets. You must have seen the last quarter, more than 2 lakh crore, 2 trillion crore has been added to the bad assets. Presently, more than 6 lakhs crore is in the bad assets. So that has caused a really problem for the bank, and you have rightly said that is why banks are not going to reduce the interest rate in the near future, in the short term. Long term, of course, when they will be flushed with funds and avenues will start coming in, they will definitely try to reduce the interest rate, especially on the advances, big corporate advances. But if you see the overall market scenario, the economy as a whole is not growing the way it should have grown. After demonetization, though it is a historical and very bold step by the government, and this budget will be a historical budget after demonetization, several people are looking to this budget because some measures will be taken so that a job is created, manufacturing sector grows. And when the manufacturing sector starts growing, I think bank will start pumping money in the market, and then percentage of NPA may come down. Right. But the way situation is there today, I think NPA will be there because big sectors like textile, iron and steel, shipbuilding, all these sectors are in a bad shape. So all these are going to add bad load. Another sector is very critical for the bank is the power sector. In the today's paper also you have seen, though government has come out with some scheme, Uday and all, but Jharkhand has failed in making payment to the DVC and all. So if these sectors start sinking, then further bad loan will be created in the banking industry.
I'm going to go over to Professor Subramaniam now. The government, Professor, has allocated a huge sum of money for the recapitalizing the banks, and this has led to a feeling where people could think that they are paying for someone else's mistake. Could this be put to better use? What do you think about that?
So before I comment on that, I just want to highlight to our viewers the problems that have led to what we find right now. I was part of the PJNI committee report that was commissioned by the Reserve Bank of India, where we delved at length and in depth on the issues that have caused the non-performing assets. While I agree with my fellow panelists that the economy not doing very well has contributed, I think the problems are a lot more deeper. In particular, in the report we highlight that the problems stem primarily from governance or lack of governance. World over, whether it's actually the global financial crisis or the Asian financial crisis or the Latin financial crisis, take any financial crisis, what you find is that banks do very well when the economy is doing well, but they do poorly when the economy is not doing well, and that is more than just cyclical. It has to do with the governance problems. It is the fact that when the tide goes away, you know who's swimming naked, and in the particular case here.
All right, I think we've lost that connection to Professor right there, but I'm going to come over to you, Mr. Sinha, till we get him back on, really. Now, with such huge debts with banks, do you think that the banks have less money or the less funds available to loan at this point of time? And that is also a reason for them to not reduce the interest rates despite the central bank reducing the repo rate. I mean, of course, we know that the repo rate has been left unchanged.
I will say in a different way. Yeah, I will say in a different way. Repo rate, of course, has started coming down, but banks are not reducing to that extent. But recent past, you must have seen 3-4 large banks have already reduced their interest rate.
Right.
A reduction of interest rate comprises of various factors. It's not only the demand for credit in the market, it also the cost of deposit. Today, the cost of deposit, if you look at this demonetization drive, where huge funds have come to the banking sector, but as a whole, if you see before November, cost of fund was very high, and this was the reason banks were not able to reduce the interest rate on credit, because if you reduce the interest rate on credit, you have to reduce the interest rate on deposit also. But reduction of interest rate on credit, immediate impact is there. But if you reduce in deposit, it is prospective effect is there. So that way, huge burden on the in cost of fund of the bank. That is why banks have not been able to reduce drastically the rate of interest. But on the other hand, if the appetite is there in the market for credit, then definitely banks are likely to reduce the rate of interest. Presently, the thing is that there is no appetite for credit pickup. There is a absolutely, I will say, very little spending by the government in the infrastructure sector. infra is such a sector, huge appetite is expected. But if you see over the last 1.5 years, there is very little appetite in the infrastructure. There are various reasons for that, like environment clearance, various statutory authority clearance are not there. That is why most of those loans are going bad. Even the power sector also. Mostly road and power, these two sectors have contributed a lot for the bad loan of the bank. And now the present government is trying to correct the path of the economy, and I hope with this new budget, which will be a historical budget for the country, especially after bold step of demonetization, we expect some easy way of doing business will come, and if that comes, I think people will be encouraged to look for more and more business. But at the same time, what I would like to say that there are a lot of agencies which look to the bank for their credit decision or for their financial decision. Decision by the bank day in and day out is in the term of money only. And if some decision result goes bad, if you start looking from a vigilance angle, then people will not get encouraged to go for more and more loan.
Sure.
So that type of fear, unless it is removed, bankers will be hesitant in lending in a big way in the market.
You just mentioned that the budget this time for the banking sector is going to be a historical one. Now, a historical one just for the benefit of viewers, because demonetization has made sure that the liquidity in the banks have reduced. With the increase in enhanced liquidity, we will see that the interest on deposits are going down with banks as well. I'm going to go over to Professor now, who has been patched on again to the show, to give us a sense of how this excessive liquidity in the bank is impacting the interest rates and what can we expect from this year's budget on that particular front.
Before I get to that, if it is okay with your permission, I just want to restate a couple of points.
Sure, you can do that and come back to my question later.
Yeah,
sure.
Because it is really important. You mentioned about the 2.5 trillion rupees of recapitalization of public sector banks that has been earmarked. We had done some estimations of the amounts that are required. 2.5 trillion actually is half of what we expect at the worst to be required. But what is important is, so that this taxpayer money does not become a case of good money put after bad. There are three key things that need to be done. First, the governance of the public sector banks needs to be fixed. There is excessive interference of the bureaucrats and the government and across governments. This is not just a particular political party, which leads to a lot of bad decisions being done. We've also mentioned that boards of the public sector banks are really disempowered. The right kind of people who understand risk management, people who understand corporate strategy, are not there. There is a lot of actually a wheeling and dealing that also goes at the board level, and for that it must be ensured that the boards are really empowered, and for which we actually had proposed the setting up of the Bank Boards Bureau and the Bank Investment Company. While the government has set up the Bank Boards Bureau as part of its Indradhanush proposal, which was proposed last year, there hasn't been movement on the setting up of the Bank Investment Company, which is really critical for the governance problems to be fixed. So to summarize, actually these governance reforms which actually connect the umbilical cord, through the umbilical cord, the public sector banks to the government, that needs to be taken care of before new money is put in.
Now, very interesting, Professor, you mentioned, yes, that's exactly what I was coming to. I mean, now we should paint the lay of the land that after demonetization, what is it that the banking sector will have to do? As far as the regulation is concerned, what would we expect from the union budget on this particular sector with the enhanced liquidity that we will be seeing in all the banks now?
So, I'm going to relate to what I have just mentioned. Historically, whenever we've seen the banking sector being flush with liquidity, that also has led to, lending that is not necessarily of the highest standards. So, oftentimes, banks being flush with money has led to relaxation in the origination norms, and which then sows the seeds for the next crisis in terms of non-performing assets, bad debt, etc. So, that is something which is important. The fact that banks are flush with liquidity, they may cut down the interest rates on the deposits, but I'd be very keen to watch if they're actually cutting down the interest rates on the loans. The reason being that if you look at the net interest margins of the public sector banks, the net interest margins have really shrunk, and this is again something that we had highlighted in the report. When you compare the net interest margins of the private sector banks vis-a-vis that of the public sector banks, the NIMs of the public sector banks look very thin. And so public sector banks, while they may be very sort of keen to cut the rates on deposits, they may not be that keen unless there is actually some suasion from the government to cut the interest rates on the lending to retain their net interest margins. That's point number one. So the second point being about the fact that this flush liquidity might create bad lending and add to what we already have unless the governance problems that I've talked about are fixed. There's a third aspect that I want to mention actually, which is in the context of ARCs. So, in summer of this year, the Reserve Bank and the government actually eased the FDI norms for ARCs. So 100% FDI can come in. Now, while that does partially help in bringing more capital to the ARCs, it does not fix some of the key problems that the ARCs are saddled with, which is the fact that when an ARC wants to buy a loan from, let's say, a banking consortium, they have to ensure that large majority, more than 60% of the banks in that consortium agree to that sale, and that takes a very long time. Secondly, in general, public sector banks are very are very reluctant to sell their loans at a discount, which is something that you have to do. If the loan is not performing well, you have to sell it at a discount, which gets in fact to some of the human resource practices in the public sector banks. If you look at the median tenure of a chairman in a public sector bank, it is about 2 years, and the provisioning norms are such that if you actually create an NPA, you have to provide the provisioning for that only over a 4-year period. In other words, if there's a loan that is declared a non-performing asset, you have to create provisions only over 4 years. In contrast, if you sell the asset to an ARC, you have to take a hit immediately, and
right.
No public sector bank chairman wants to actually take that hit immediately. So these are some structural issues that really need to be tackled if we have to actually go forward.
Actually, you mentioned about the structural issues that require changing as far as the public sector undertakings are concerned, in the banking sector and the privatization as well. Both the panelists indeed have made some fantastic points about the ARCs, which are the asset reconstruction companies as well. Now, moving on a little bit from there, more than half of the Indian population is excluded from the financial system. They don't even know how to make their way through traditional banking, and in this day and age, we expect them to take a double leap. They should be both digitally and financially literate, and more so after the recent move of demonetization. Our correspondent Snith brings you this particular story. Take a look.
A fast-changing landscape and a struggle with a crumbling infrastructure aptly sums up the banking structure of India. Banking in India remains one of the most non-inclusive services. A 2014 World Bank report stated that 47% of Indian adults were cut off from the financial system. Indian Prime Minister Narendra Modi announced the Jan Dhan Yojana scheme in the same year. 3 years on, there are around 26 crore accounts reflecting a true need for financial literacy in the country. A 2016 McKinsey report has estimated that Indians lose more than $2 billion per year in traveling to and fro from a bank. The same report has stated that digital finance is a $700 billion opportunity for India. While the report didn't do much for a push towards digital finance in India, the November 2016 decision of demonetization by the government did. the government made a push for digital finance, which includes financial transactions made using mobile phones, internet or cards linked to a digital payment system, but overlooked several facts. According to the RBI, there are about 15 lakh point of sales machines in India as of August 2016. India has 712.5 million debit cards. And according to a report by the TRAI, teledensity is at 83%, whereas in states like Assam, Madhya Pradesh, Uttar Pradesh, the teledensity is less than 70%. With many using multiple SIM cards, the number only gives us a rough representation for how many in the country can actually actively use digital banking. Many vendors and small businesses transitioned to digital payments. But for many, going digital proved to be a tough challenge.
ग्राहक तो आ रहे थे मगर वो कोई क्रेडिट कार्ड डेबिट कार्ड लेके तो कोई बोलता था कि पेटीएम एक्सेप्ट करो, तो हम लोगों के पास ऐसा कुछ था नहीं सिस्टम, तो हम कैसे करें, इसलिए ग्राहक अपना चुप होकर चले जाते थे.
For some it was an easy move and claim it helped people get into the formal financial system.
We started using the card much more. Okay, like even the domestic help at home, the maid, she was ready to take her pay by check. The driver was ready to take the pay by check. So it did not really affect me to go and stand in the long ATM lines and all. I never had to go even once to stand in the ATM line because all the payments were done through card or through check.
A push towards a digital economy would mean that each transaction can be tracked and documented. Now, while this works great for the Indian government, the Indian citizens will have a tough time moving towards it. In a country where many are struggling with basic needs and where they come from diverse economic backgrounds, the Indian government needs to spell out more initiatives and needs to give the push towards digital economy some time. In Delhi, Snig Pontial for WION.
Well, now there is surely a need to financially educate a large section of the population. There is a certain amount in the budget that needs to be allocated specifically really for this. I'm going to bring in both our panelists now on the show back on, Professor Krishnamurthy and Mr. S.A. Sinha as well. You just took a look at financial literacy as well. Both of you all, this is a question. First up, let's start with our studio guest, Mr. Sinha. What do you think about financial literacy in India, and how much budget do you think in the upcoming budget would be allocated for this particular initiative?
You see, they have rightly said that most of the villagers, they are unaware of digital banking. At the same time, you know, we say that necessity is the mother of invention. So now the necessity has arisen all over the India after demonetization. Now everybody is looking to the digital banking. Even the smallest man, the smallest person, farmers, they are all looking for the digital banking. So banks have also started financial literacy program. It was already there in the past because in the financial literacy program, banks were propagating mainly for the agri credit and all these things. But now to use the digital banking, financial literacy is very, very essential. Everybody doesn't know how to use this, like, you know, Bhim app or Paytm. Though most of the people have started learning, but it's still miles to go.
And what's your sense about the banking sector being present in the absolute rural areas in the country as well?
You see, banking sectors are present, banking sectors are there all over the country, but still a lot of penetration is required. That is why government has, RBI has given license for, you know, payment bank. Payment banks are also coming new. New banks have all, like Bandhan Bank have also come, and these are the banks who are focusing mainly on the rural and semi or unbanked area. Though public sector banks are there, remote area also, but we require some more penetration in the rural area, semi-urban area.
And you will see that thrust come in from the union government in this particular upcoming
so
budget,
now
right?
the government is focusing for opening more and more branches, but not the public sector branches alone. The government is focusing through this payment bank, this regional rural banks are there, like business correspondent models are there. You see, the other day I was with this postal bank people. They want to deliver banking facilities through their postman.
Right.
So they will become the business correspondent. So those models are also coming. You will find in the banking financial sector revolutionary changes in the next 1 or 2 years time. And
Sure.
that is possible when financial literacy program is enhanced and strengthened, and for that sufficient allocation in the budget should also be there, because these are cost incentive. For every program you have to incur cost, so that incentive has to be provided by the government.
Sure. Yeah. We will be watching out for those in the upcoming union budget. Closing comments from my other panelist, Professor Krishnamurthy Subramaniam. What would be your expectations of the banking sector from the budget, and what are the kind of benefits really that the public will get from this particular union budget, and especially the thrust in terms of the deeper penetration of private as well as public banks in the rural areas, especially after demonetization?
So, because you mentioned this as a possibly seminal budget given the demonetization move, I actually want to put the demonetization move in perspective. If you think about the two main ills that are actually grappling this country, number one, tax evasion, particularly among self-employed, and number two, corruption. Both are issues that are quite related to the absence of the digital economy or the dominance of the cash economy in this country. And therefore, the demonetization move actually is attempting a cultural change, a regime shift, and therefore, the benefits of this actually should be seen not just in the context of the forthcoming budget, but the subsequent budgets as well, because this is a move one political move that is not a myopic one. This is actually a long-term move, and therefore I really commend the government for having the political courage to do this. Now let me come to actually what needs to happen. So number one, of course, in order to reap the benefits from this move, not only the budget but other measures also need to be taken. Of course, the digital economy is something that is important, but financial literacy is important as well, because a recent survey that was done by S&P showed that 3/4 of Indians are actually not very familiar with very simple financial concepts like diversification, compounding, etc. And therefore, in order to really benefit from bringing these people into the mainstream of the banking system, it is important to make them literate. So number one. Second, given the fact that there's going to be a lot of data that's going to be generated now from the digital transactions, the government really needs to put together a crack team that actually can analyze this data. There's been significant advances in big data analysis, analysis of big data that should be used by putting together data sets. For instance, I'll give you an example. If you think about self-employed individuals, pick a dentist or a doctor that operates, let's say, in Cuff Parade in Delhi versus someone who actually operates, let's say, in Hyderabad. The extent of the difference between what they reveal on their tax return and what they actually earn can be as large as 150%. For someone, let's say, in Hyderabad, maybe even 300% for someone operating so let's say in Cuff Parade in Mumbai. So now by tracking the digital transactions, there's a huge opportunity to try and get these people into the tax net and therefore expand the tax bracket. Expanding the tax bracket can also provide the government the opportunity to reduce the tax rate itself and thereby actually really provide the benefits to several individuals. Because remember, a population of 1.2 billion has cooperated so beautifully with such a gigantic exercise, and therefore they deserve the benefits through lower tax rates.
Absolutely. Thank you so much. A wonderful point brought out by both our panelists. Unfortunately, that's all the time that we have on this particular edition of the Union Budget Special on the banking and financial sector. We'd like to thank our panelists, Mr. S.C. Sinha, who's the former ED of Oriental Bank of Commerce, and Professor Krishnamurthy Subramaniam, who's the member of Board of Directors at Bandhan Bank and an associate professor at ISB as well. Thank you so much, all our viewers, for tuning into WION World is One News. We will see you tomorrow evening at 5:30 p.m. with yet another sector and the expectations from the upcoming budget in that particular sector.